So you had a strategy that works for months, and then just one day it stops working, right? Using the same setups, same rules, same executions, but now your strategy just doesn't work. So you assume that you broke something, right? You add an indicator, you try to change something, but the strategy didn't actually break. What's under it broke, right? The market regime shifted, and your strategy was built for a different market regime than we're currently in. So today, I want to go over what a regime is and how we can kind of identify what regime we're in and how different regimes can shift how our trading styles should be. So what is an actual regime? So regime is just the character of the market over a period. We don't predict where the market's going with the regime. We just character is just an observation of what's happening, right? And then we adapt to what's happening in the market. And every edge is conditional, right? When somebody tells you that this setup works, every single day, oh, this setup presents every single day, it might present every single day during the 4 months that we're in an uptrend, sure. But as soon as we get back into chop, it's not going to work anymore. So you need to be able to adapt to different market regimes based on your strategy. You need to identify what market regimes your strategy is strong in and what market regimes your strategy is weak in, right? And the analogy for it is it's not a strategy problem, it's more of like a terrain problem. So like snow tires aren't a bad product because they don't work in July, right? They don't work in July because there's no snow in July, right? Just because you trade breakouts and then we get into consolidation doesn't mean that trading breakouts is bad, but you're trying to trade breakouts when there's no breakouts to be taken. That makes sense? So what are kind of your three main ones that you need to look at? So we have trending regimes, we have ranging chop regimes, and we have high volatility expansion regimes. So for an example, let's look at this period here. So from about we'll go Monday, May 12th of 2025. So we look here, we're making higher highs, higher lows, higher highs, higher lows, right? We're moving up nice and cleanly, right? I think that we can all identify that that is just an uptrend. We are just moving up, nice and clean, right? Then we have high volatility expansion. So this is where the market expands and goes up, and in times that, like, let's look at this entire uptrend. So this entire uptrend was 4,700 points, give or take. If we look here, this was significantly less time from here to here, but how many points did we move? We moved 7,600 points, give or take, in significantly less time, right? That's because we were in a high volatility expansion regime. And now the problem with a high volatility expansion regime is if you're using fixed TPs and fixed stop losses, your TP as a percentage of the day's range is significantly smaller. So it starts to just become noise, right? And then we can look at ranging chop. So if we look at just recently here, we can see that this is pretty well a range, right? We're coming down to the bottom of it, rejecting off the bottom of it, and coming back up. We're coming down close to the bottom of it, rejecting, coming back up, right? So we're kind of caught just in a choppy range right now. And the things that work kind of in a range are like your mean reversions, fading the extremes. You kind of want tight targets and making sure that you don't try to catch, that 400 point move of the day. In a trend, you want like breakouts, going with the momentum and just following the trend. And then in high volatility expansion, you want wide parameters, smaller size, or you just sit out of it entirely. Obviously, you don't want to sit out of this big breakout of the range, but you do need to identify that we're in a time when 400 point ranges for the day aren't going to be had, right? We're going to have 800 point days, we're going to have 1,000 point day, right? Stuff like that, and you need to be able to identify it. So how can we actually identify what regime we're in? So we can use something like a volatility measure, like an ATR or something like that, where we can look at what the average ATR over a period was and now what our ATR is now to see if we're starting to break out and get more volatile. We can go for like a follow through test so we can see when price comes up and retest the high, does it reject off the high or does it break through? We can use where the closes are. So if we are consistently closing above previous day's close, we're obviously in an uptrend. If we're consistently closing above or below previous day's close, we're obviously in a downtrend. Stuff like that. And you can just use your own results as well. right? If you know that your strategy works good in an uptrend and all of a sudden you stop getting those breakouts or whatever you get, now we're probably getting out of a breakout regime or a regime that is favorable to trade breakouts in. But the problem is that you can't identify regimes perfectly in real time. Regimes are super obvious when we look back. And we look back at price action, we're like, oh yeah, that was obviously, high volatility expansion. But, if I'm trading on April 6th of 2026, I'm not going to know that we're going to run 4,000 points in the next couple of days or in the next month, right? There's no way to actually know that in the time. So you need to kind of make an educated guess at what regime we're in and if we're going to break out of that regime, and then tailor your strategy based on that. So what can you actually do when you notice that the regime is shifting, your strategy isn't working in a regime anymore? So the one thing that's the easiest thing to do is just sit it out, right? Nobody likes doing that. Nobody likes sitting out a regime, missing out on opportunities, stuff like that, just because we're in a regime and you don't know how long we're gonna be in it. Now the plus side to it is it's free. It's not gonna cost you money, it's not gonna cost you losses, nothing like that. Another thing is we can adjust parameters to the environment. So if we know, oh, we're in a high volatility regime, maybe we use a little bit less size, but we use higher TPs, higher stop losses. Maybe we're in a consolidation regime, so we're going to use tighter TPs, tighter stop losses, stuff like that. Or we can develop multiple edges. So we can make an edge that works good in for continuations. We can make an edge that works good in consolidation, stuff like that. And then we can use those different edges and those different strategies and rotate between them based upon what we identify as the market regime. But the problem that everybody picks is to always change their strategy. So you have, 5 bad days and you're like, okay, I totally need to change my strategy. I need to get off of this model that I was trading. I need to trade something totally different. But that's not the right thing to do because you're looking back at it. So let's say you're trading an orb strategy, you're getting breakouts for 3 months, it's printing, and then for 2 weeks you don't get anything. So you're like, okay, I need to stop trading orb, I need to stop trading breakouts, I'm gonna start trading mean reversions. Well, now we're already a week into a market regime where mean reversions might work. So you're already behind the curve. So maybe you only get another week left of consolidation, and then we get back into breakouts again. And now you're trying to trade mean reversions inside of a breakout when you really should have just been trading your breakout. Does that make sense? So the wrong response is just to totally change your strategy. The right response in that aspect would be to develop another strategy that pairs alongside your current strategy so you can shift strategies based on the market regime you identify we're in. The other problem is with backtests. So let's say we backtest a strategy from whenever, from a time that we're in an uptrend. Well, if the entire time that you backtest were just an uptrend, then you're identifying things that happen in an uptrend. But if all of a sudden we get into consolidation, now you don't have any data on consolidation, right? You only have data on a uptrending or a ranging market. So that you need to be able to identify that as well with your backtest is what regime am I backtesting in? But that fairly well concludes what a regime is and what we can kind of do about a regime. I don't know what else I can kind of talk about. In my Discord, I always answer questions for everybody. I'll leave a link to it in the description. If you have any questions at all, join my Discord. I'm always in voice chat and I'm always active in chat. If you have any questions, just text me in there, at me, whatever. But the next time that your strategy stops working, before you kind of tear it down and totally make a new strategy, you should ask yourself what changed. So, is your strategy just not good anymore? Has your strategy lost its edge? Or has the market regime shifted and your edge was conditional to the market regime it was built for, which is likely what actually happened. So, that concludes it. I appreciate y'all watching. I would appreciate a like and a comment, whatever else, a subscribe. That helps massively with engagement and stuff. Obviously, I'm trying to grow this stuff. I appreciate y'all a ton, and I'll catch y'all in the next one.